Hello and welcome to Passive Investing 101 Portfolio Risk. We're going to talk a little bit about how to maximize your fortress. And essentially, the goal for today is we're going to talk about risk and how to include that paradigm in your portfolio. A little bit about me. I am a seasoned real estate professional, I like to say. Really ton of experience on Main Street to institutional also. We did some experience with the uh, investing with real estate REIT early in my career, all the way through to Main Street. Mainly focused my practice on that. However, I did commercial and landlord tenant for a large telecom company that rhymes with Sprint. Now a part of T-Mobile, of course. So a ton of different experiences on an institutional basis, and really my passion though is to help passive investors build their portfolio. And a little bit about my story. My dad was a truck driver. My mom was a hairdresser. So in terms of real estate investing and all that, there was definitely not much going on with those guys in terms of understanding what we could do. And that's part of what sparked my passion of seeing. It's kind of funny. It's almost embarrassing, maybe, but it's what started a fire. Carlton Sheets was a late night infomercial guru, if you will, talking about real estate with no money down. And I'm like, that's interesting. You can make money with real estate? What? So I really got interested and I went down and actually bought the course. Now, of course, I didn't. I made like 3 phone calls and didn't do anything with it. But for sure, it sparked an interest in real estate that kind of informed my education from there. Went on to college and eventually to law school. And I will say that was the beginning of an understanding. And also at the same time was helping a friend of mine's dad who had like 4 rentals and, mowing lawns, helping hang drywall, all those kind of things in terms of doing unit turns and that stuff. And that's how I got started. Okay, so what we're going to accomplish today, I'd like to talk a little bit about asymmetric risk. We're going to talk about taking bets that are highly in our favor. That's the number one goal. We're also going to talk about the risk-free rate in terms of, okay, should I do this deal and am I being compensated? We're also going to talk about real estate strategies on a risk continuum. And then finally, we're not going to cover it very, very much, but I'm going to share a resource that also talks about other asset classes in case you're interested in what those risk profiles look like. All right, I love to start with this slide. Essentially, this is what asymmetric risk is all about. We're definitely going to go for opportunities where our risk is small, but our upside's big. And really, that's where you first want to start. What are my risk reward wise? What am I looking at? Am I being compensated for risk I take? And that's the number one question I think you should ask in terms of any opportunity to invest in anything, really, but especially any real estate deals you're looking at. If you have an opportunity to do that, what does that profile look like? And to start with the financial aspect of it in terms of risk reward, let's talk about the risk-free rate. Excuse me. So basically, the risk-free rate is considered some sort of government treasury, as controversial as that may be. But essentially, a 10-year note is a good proxy for a real estate investment. A lot of the real estate mortgages are on a 10-year horizon, so that gives you a good feel. And so, for example, the 10-year treasury on December 17th was right around 3.86. So that gives you a floor to say, well, am I investing in something? Well, for sure, anything above 3.86 is the risk premium that you're charging. So that's the first concept that we want to think of. Anything above 3.86 over the 10-year horizon is a risk premium of some sort. And so that's what that looks like. And then essentially another way we're looking at it too is the time horizon also is a matter for sure. If you have a 1-year deal, then for sure the interest rate's going to be much lower than the 10-year treasury. So you're going to look in terms of how short the duration is. That's also a part of this. And so above and beyond the risk-free rate is a market return, and essentially lets you know, are you being compensated for that risk you're taking? And so essentially, if someone offers you a development deal and they're only going to pay you 3%, then that's really crazy, right? Because you're taking a ton of risk where you could put the money in a 10-year treasury at 3%. Why on earth would you take that much risk and not be rewarded for it? So that's essentially what the concept is all about. Also, talk a little bit about non-correlated assets. One of the key functions of real estate is to help you build you a non-correlated portfolio, or take some of the market risk out. So as you may be aware, the market in terms of the stock market has wild gyrations at times, and so one of the things you can do to balance your portfolio out is have non-correlated assets like real estate, metals, other assets that are not traded frequently like that. And then here's another way to look at it too. Expected potential versus the risk. And so what we want to do is, the more risk we take, then we have to see higher returns or expected returns to justify it. So for example, if you're looking at a emerging market stock in Brazil, or a bond issued by General Electric or a major company, you're going to want a significant amount more returns to justify taking that risk on an emerging market. So that is a part of what you're trying to do in terms of analyzing risk. And as we can see here, property is somewhere in the in between, in a nice balanced expected return versus reward ratio there. Okay, now let's talk about real estate specific strategies and how they differ. So for example, if you were investing in real estate debt, that's actually pretty low, right? Because especially if you're a first lien, you're collateralized by that property, and your chances of losing are very low if you're collateralized by the property, right? And then core asset strategies are more like, well, we're going to be in a bigger city, and it's a stabilized deal, really cash flowing nicely, big city like an 18-hour city, Denver, Salt Lake, anywhere that's got a normal strategy with normal diversification in terms of job base and everything for the tenant. So usually a pretty solid strategy, and therefore it's typically not going to pay as much, right? It shouldn't, and that's okay, because we're going to expect a really stable deal, and we're going to accept bond-like returns because we're like, hey, this is a really stable opportunity, and we're going to make sure that's what we're looking for. And then you have core plus, which is a little bit more opportunities. Like, let's say it's a rundown 1970s property in a nice area, but there's a lot of deferred maintenance, and they haven't reinvested capital in it. That's a great opportunity, because you're going to have an opportunity to reposition the property, and so that can be a real great opportunity, in that it's got a lot of the same characteristics of core, but we're going to do a little bit of refurbishment, clean the place up a little bit, and then enjoy pretty good returns just because it's in a great area. And then we get into the more aggressive value add, where we're really doing deep rehabs and repositioning the property in terms of, hey, we're going to like redo the fixtures, we're going to make the bathrooms nice, perhaps add a washer dryer, that kind of stuff. And then we get further out there on the risk reward strategy. So we really want to expect more when we start seeing those kind of deals. And then, of course, my personal favorite, I really love the opportunistic arena. We love development, especially build to rent. That's a really great profile right now. Again, there's there should be a much higher return because it is a real estate deal. You're going to expect development deals to have a lot higher returns to justify taking the risk. Another important thing to note about this too is, like, you can buy a REIT for some of this stuff here. So these are public vehicles. They're low risk, but the flip side is the return profiles are never going to really generate a huge pop in your returns. And so if you have a longer time horizon in your portfolio investing, if you're not retiring in the next 5 years, then you can really start to look at these more aggressive strategies to provide a much better return relative to risk. Also wanted to share this. I thought this was an excellent breakdown of like what you should be receiving. Like for example, development deals target return 24%. I think it should be higher right now. I think you should be getting closer to 30. The value add deals where you're doing the rehabs, anywhere from a 17 to 24% IRR. The core plus, you can start to accept 12 to 17, something pretty mellow. Minimal to moderate risk, moderate to high, and then on the high end. That's pretty much how that'll break down. And then with the REITs, a 7% return, you really can't be too upset because you're just basically taking almost no risk when it comes to that. And the last 3 slides, by the way, I cannot recommend this article any higher. This is where the last three slides came from. I thought that did an incredible job of breaking it down in one article. So I wanted to make sure I include that and give them credit for the incredible job they did. So what we're going to turn to now is just wanted to share this wonderful slide. This is and I'm not even sure who to give credit. I've seen this floating around, and if I could find out who to give credit to, I completely would, because this is an incredible chart that breaks down alternative investments to kind of let you know, okay, risk reward wise, what we're talking about. So essentially, private equity, real estate, and so we have a risk premium, and so it goes from risky to higher risk. I think I'm trying to remember how it works, but it does have a risk rating, and really encourage you guys to take a look at this. Like classic cars, all kinds of different opportunities, and it gives you a breakdown on the least risky all the way down to the most risky, depending on how you look at it. And so it gives you an idea of like, okay, if I'm going to do, say, for example, foreign currency, well, that's pretty risky. Then you need to accept a very good return to justify doing it. And so, for example, that right there helps you think in terms of that slide and gives you some ideas when you're evaluating some other. Let's say, for example, you're working with our friends at EQRP and doing a self-directed 401k plan. You may want to put some of these other alternative investments that you can't if you're with an employer. They would never let you do this. However, if you're self-directing your IRA or your 401k, you can think about these other asset classes that you can put in your portfolio. And so I did want to conclude by sharing that that slide, and for sure, if you guys have any questions or would like to discuss anything we talked about in this slide or how we can help, please reach out to me, and really happy to help out. And with that, I'm going to open the floor to some questions.